Up next, we've got Buff Dormeier.
Okay, and is he available?
I know he's in the room. How's it going, Buff?
Hey, I'm doing great. Thanks,
Hey,
Kate.
Buff, can you hear me?
Yes, can you hear you just fine? Can you hear me all right?
Absolutely. Go ahead
All
and
right,
get your
wonderful.
PowerPoint up. Buff Dormier, is that how you say your name?
Some people do.
Okay, that's close.
Dormeyer.
Dormeyer. Okay, Buff is CMT is a foremost expert on volume analysis. And I know people who swear by this. Buff serves as the Chief Technical Analyst at Kingsview Investment Management and is an index specialist for Monarch Funds ETFs. In 2007, Dormeyer's technical research was awarded the prestigious Charles H. Dow Award. Also, an award-winning author, Buff authored Investing with Volume Analysis, published by FT Press and partnering with the Financial Times Press. Pearson Publishing, and the Wharton School. I worked for the Financial Times for about 10 years. This is the only book to win both Technical Analyst Book of the Year in 2013 and Trader Planet's top book resource in 2012 to date. Buff's work has also been featured in a variety of national and international publications and technical journals. Buff's newest work, The Volume Factor, is scheduled for release July 2nd, 2024. So, Buff, where are you broadcasting from today?
Uh, I'm from Fort Wayne, Indiana, my
Fort
hometown.
Wayne, Indiana. I believe I have a state park named after an ancestor near there. Ever heard of Ruth Slocum?
No, I have not, but you'll have to send me the information. I'll check that out.
It's a state park in Indiana named after a Revolutionary War ancestor of mine.
Wow. Do you follow your family history?
My mother was the West Coast head of the Daughters of the American Revolution.
Oh, wow. Yeah,
And
what a great
spent
hobby.
40 years tracing our family history. We have 17 Revolutionary War veterans, and the family traces back to the Domesday Book in England 1,000 years ago.
Wow,
So
that's
if you're looking
amazing.
for someone to one up you on ancestry, I'm your guy. I'm a direct descendant of Louis the 16th also, although I'm not
Wow.
sure whether it's legitimate or illegitimate. Louis the 16th got around a lot. Anyway, you have until 5 minutes before the hour, and then we have our next batch of prizes to hand out for the day. I'm going to go ahead and mute myself, and you have the floor.
All right, thank you. Today, John, I'm gonna talk about my most favorite topic, volume. And volume is not only a valuable piece of market data, an indispensable leading indicator, but it is also the undiscovered market factor. And not just any factor, volume is the factor that rules them all. It's the monarch of factors because volume is the force that empowers price momentum and sustains trends. In this way, the volume factor is the missing piece bridging goals-based financial planning to technical analysis via tactical asset management. Here we go. So volume is the unknown investment factor. And as your volume evangelist, I'm going to provide you with 4 rational points, all starting with the same letter, R. These are the 4 R's of volume. First of all, volume is responsive. Volume provides quicker information. You may have heard the term volume leads price. Changes in volume generally occur before significant price movements. Number 2, reliability. Volume confirms price. The market is perhaps the world's greatest discounting mechanism. In this way, price is the market's testimony. If price is the market's DNA because it contains all the collective knowledge of investors, then volume is its polygraph or its RNA. As RNA interprets the meaning of DNA, volume interprets and decodes price. So in this way, volume may not only get you into a trend movement faster, but simultaneously increases the probability that that price trend momentum will continue on into the future. The number 3 is risk. By differentiating a legitimate trend from a suspect trend, and by identifying trend weakness early on, investors using volume should be better positioned to reduce the risk in their portfolios. And number 4, returns. If we're able to identify a trend earlier and have a higher probability of being positioned correctly, then we're putting the odds in our favor and positioning ourselves for a better return. Now, think of volume like this. You're now the pilot of an airplane, and you desire that plane to go higher. So what do? You change the trajectory of the plane, you aim it higher. However, if you did that, and you just did that alone, what direction will the plane go? Well, it's not going to go up, it's going to go down. Why? Failing to provide thrust through increased fuel, the plane will likely stall. So now, what is the fuel of the markets? It is volume, or capital is that fuel of the market. It takes more and more people willing to participate at ever-increasing prices to keep the proverbial plane ascending. If the market's moving ever higher with fewer and fewer capital flows, then the market lacks the fuel or the force or thrust to continue and may likely stall out on its own. So let's review together how to use volume analysis. Okay, so this is my 4 quadrants here, but let's first define a couple terms. So first of all, trend. An uptrend is represented by greed. Greed is needy. It's kind of like that song, it always wants more, more, more. Next is a downtrend. A downtrend represents fear. Fear operates on a herd mentality. Get me out, we'll figure it out later. The next term here would be energy. Okay, so rising volume is force or energy, whereas falling volume operates under the laws of entropy. So let's just quickly go through our 4 quadrants here. First, we have an uptrend with rising volume. This is greed with energy. This market is in a state of invigorated greed or strong demand. The uptrend is being confirmed by rising volume, and the implication is bullish. Next, we have a trend that's up under falling volume. This isn't greed with energy, but greed with entropy. This market is a complacent market or under weak demand, uptrends being contradicted by the falling volume, and the implication going forward is bearish. Next, we have a trend that's down with rising volume. This is fear with energy or fear. A market under strong supply, the downtrend's being confirmed by rising volume, more people willing to sell at ever decreasing prices. The implication is bearish. And then finally, our last quadrant here, the trend is down. We have falling volume. This is fear in a state of entropy. This is an apathetic market under weak supply. The downtrend is being contradicted by fewer and fewer people willing to sell at ever decreasing prices, and the outlook here is bullish. So you got to know when to hold them, but more importantly, you got to know which ones to hold. We want to own the ones garnering the most capital flows and using volume analysis. Okay, so the first law here is the law of incremental returns. Just give you an example here. My daughter is on this traveling soccer team. Okay, and what I tell her is if she goes into every practice and she gives it her all, she's putting 100% in. Okay, The coach also requires them to, on the days they don't have practice or games, to put in 30 minutes to work out on their own. That's like going from 100% to 110%. Now, there's some girls on this team, they're real standouts, okay? And they put in extra work. So I tell my daughter, if you want to go from 110% to 120%, how much work do you need to put in? Well, she answers 10% more. I go, no, since you're already at 110, you only need 9% to get to 120. And once you're at 120, you only need 8% more to get to 130. And if you're at 130, you need only 7% more to get to approximately 140. And if you're at 140, you only need about 6% more to get to 150. This is the law of compounding, okay? We want to run with the bulls when we have momentum, when the markets are trending up. Okay, so what powers the bull is volume. Now, I like to think of volume as synonymous with force. Okay, now here's Webster's Dictionary of Force. Force is a power made operative against support and resistance. Okay, well, Technical Analysis 101, what is support? Support is an area where buyers reside. And what's resistance? Resistance is an area where the sellers reside. And what's an uptrend? An uptrend is just a rising support line, and a downtrend is a falling resistance line. Now, moving to Technical Analysis 400, volume is that force required to sustain those trends. So now let's take a look at another dictionary, the Physics Dictionary, and it defines force as this. Force is a vector quantity that tends to produce an acceleration. Well, this confirms a major tenet of Charles, since the days of Charles Dow, over a century ago, that volume leads price. This statement also infers volume plays a crucial role in momentum analysis, which brings us to our volume factor offense. So we can better understand volume's role in momentum analysis through the laws of Newtonian physics. Okay, first definition. And the first law of motion is inertia. An object at rest remains at rest. An object in motion remains in motion at a constant speed and in a straight line unless acted upon by what? An unbalanced force. Okay, so we could restate this definition in terms of momentum analysis like this. A trend in motion or momentum tends to remain in motion at a constant speed and a straight line unless acted upon by unbalanced volume. My old friend Joe Granville would have liked to say on balance. What we're really looking at here is that volume is the cause and price is just the effect. So volume is the unbalanced force causing price change. Yet most all momentum analysis focus strictly on the cause, or excuse me, the effect, and ignores the cause. So let's begin our illustrations by looking at some of our indicators void of our unbalanced force or volume analysis, volume data in the calculations. Okay. All right, so in this study here, okay, so there are two primary types of a momentum. One is internal momentum. That it means that the momentum is relative to itself. And then there's external momentum relative to other securities, most likely an index. Okay, now perhaps the most popular internal momentum indicator is Wells Wilder's RSI. That's the relative strength index. Now, shown here is the results of S&P Research researcher Richard Tortello, who from 1992 to 2007 studied and backtested thousands of indicators and fundamental ratios. And this can be found in his book, Quantitative Strategies to Achieve Alpha. This isn't a popular book, but I highly recommend it. Now, the vast majority of those indicators and ratios that were tested were fundamental. However, of all the thousands of indicators and tested, it was this RSI that showed the strongest alpha. And shown here in this chart are the results studied and broken down by quintiles. Now, here are the top quintiles of RSI. The very top quintile produced a 6% alpha. And notice the bottom quintile, those stocks with the lowest RSI going forward, produced a net loss 3% in alpha. So notice symmetrically here, the higher the RSI, the higher the returns, the lower the RSI, the lower the returns. Now, we did our own study on RSI, and our dates were a little different. This was the previous one here was from 92 to 2007. Okay, our study on RSI went from 2002 to 2023 using the Russell 3000. And here are the results, not by quintile, but by decile. Okay, and notice the high RSI, the stock actually underperformed the market, whereas the stocks with the lowest RSIs outperformed by about 7%. So these results show almost the exact opposite in these more recent observations, with low RSI significantly outperforming stocks with high SRI. Now, the lesson I want you to take from here is that momentum analysis works, but it can be finicky. Sometimes it works really well, but sometimes it'll go out of favor. And sometimes it works, but just differently. So relative strength, RS, compares a security's momentum to that of another security. This is external relative strength. So comparing a stock to the S&P 500, that's relative strength, or RS. Okay, RS is generally when you see factors, market factors, that this is generally the tool that they're using is relative strength. So as investors, we should not be surprised that relative strength was one of the very top producers of alpha in Tortillo's studies. Again, this is from 92 to 2007, same source. Okay, so his study from 92 to 97, the highest quintile outperformed by 3%, whereas the stocks with the lowest or weakest relative strength underperformed by 3%. So now, again, we did our own study, a couple decades of data again from 2002 to 2023, okay? And we confirmed here that RS does add alpha. Okay, the top decile RS outperformed by nearly 4%. However, also the bottom decile outperformed by about 5%. Now, let's look at the second law of motion, or force, okay, defined as this: the acceleration of an object depends on the mass of the object and the amount of force applied. So rephrasing this in momentum analysis, the more volume or force being applied to price, the stronger the expectation momentum. So price acceleration is powered through volume. This is volume analysis, understanding the amount of volume or force required to move a security at a given distance at a particular speed. Okay, now with this in mind, what happens when we infuse volume data into our RSI indicator? We can do this by looking at the MFI, the money flow index, which is essentially a volume weighted RSI. And so notice what happens here when we add volume to the RSI with the money flow index. We take this 2% loss and we flip it into a 2% gain, from a 2% losing strategy to a 2% outperforming strategy, as evidenced by these top decile results. Okay, now here's the most important law, but the one generally everybody misses. Okay, Newton's third law of motion, the action and reaction. This is the law of volume, price volume asymmetry. Every action has an equal and opposite reaction. Okay, the difference between momentum and volume exposes an asymmetry between price momentum and its volume. Okay, this is the key. This is the delta between momentum and volume. Demand pushes, supply pushes back. We want to measure this, okay? So the first indicator we're going to use to measure this is my volume price confirmation indicator. It exposes the asymmetry between a price trend and a volume weighted price trend. Now, the goal of the VPCI, the volume price confirmation indicator, is to verify if the trend if volume is confirming the trend or not. It's not designed to be used in isolation, but rather in coordination with trends or trend indicators. However, in this study that I'm showing here, we took the top 10% of the VPCI in isolation, buying the top 10% highest VPCI stocks in the S&P 500. Otherwise, this top 50 stocks in the S&P 500 with the highest VPCI scores. And then we sold them when they fell out of the top 50%. And this strategy here, indicated by the red line, produced 3% in alpha over the last 2 decades. Now check this one out. This is one of my newly released indicators, the VMI, or Volume Momentum Indicator. Here we're doing the same thing with the VPCI, except not using trends, but we utilize momentum. It is the difference. It's just real simple. The difference between the RSI and the MFIs exposes the asymmetry between momentum and volume weighted momentum. Notice by investing in the top decile stocks here of the VMI, our annualized returns moves from a little over 12.5% to nearly 20%. So let's just review. Newton's laws of motion. Volume is the unbalanced force causing price change. Second law of motion. Price acceleration or momentum is powered through volume. And third law of motion, the difference between momentum and volume adjusted momentum exposes an asymmetry between price momentum and its volume. Price is the effect, volume is the cause, yet most analysis studying just studies the effect when we would be better served understanding the underlying cause. So what we're going to do next is we're going to take our 3 winning strategies. We're going to use relative strength, but not just any relative strength. We're going to use absolute relative strength. If you remember your math, absolute means you take both the positive and the negative. So we're going to take here the top decile and the 10th decile for absolute strength. We're going to use the VPCI, and we're going to combine it with the VMI, or the volume momentum factor. Okay, and we're going to combine these traits all together and then test it out as one strategy. And in doing so, here are the decile results by combining these components, these factors together into one attribute. Okay, the top decile attributes of these combined components, again, absolute relative strength, the VPCI trend asymmetry, and VMI volume momentum asymmetry returned an astonishing 24.5% annualized return, almost doubling our benchmark here of 12.6% return. Putting this into dollar terms, here are each one of the deciles, 1 through 10, and the benchmark. So to kind of put this in other words, if you if you were to put $10,000 into a Roth IRA 20 years ago, over the past 2 decades, your money would have grown to 123,584 with the benchmark. But using these characteristics, the top decile, it would have grown over $1 million. And these in decile 1 with the highest volume factor trades. So defense wins championships by keeping you in the game. So you got to know when to fold them and know when to walk away. So here's part 2. The more difficult part of the game plan is the defense. Now, unfortunately for investors, the law of compounding also work in reverse. And when we're managing money, we have to remember our capital. It is precious. Okay. And we have to, plan A has to be a plan to protect our capital. Okay. So if you lose 10%, you need 11% to get back even. You lose 20%, you need 25% to get back to even. You lose 25%, you need 34, 35, 54. And if you lose half your money, you need to double it to get back to even. Okay. So we need profits. They take care of themselves. Losers, they never do. This is why the NASDAQ, which has been on a complete tear, didn't make new highs before the S&P, because the S&P went down about 20%. It only needed to get back to 25. The NASDAQ was down almost 35%. It needed to get back 54. Okay. This is why defense is an important part of the game. And if you employ the volume, a volume factor risk overlay, you only need to get back 11 from a 10% return. Okay, now, so the laws, this is kind of like the law of reverse compounding, and they're even more exaggerated in the distribution phase. Some people call this dollar cost averaging in reverse. So here we have someone that retired with $1 million. They decided, well, the market makes, 12% a year. It did in the 80s and the 90s. I could certainly take out 5 or 50,000 a year, I'll be fine. But by 2003, by the beginning of 2003, half their money is gone. So now it's not a 5% distribution anymore. Now it's 10. 2008 rolls around, they're left with a third of their money. And by the end of 2 decades, they're down to, $400,000. Okay, this isn't a problem with choosing a bad investment. This was probably one of the best investments one could have chose. But it's a problem with not employing risk management. Okay, so I'm just going to skip this one. Okay, so if you're a professional investor, your foremost job is risk management. When markets are up, they don't think they need you. But when they're down, you become indispensable. So you need to know how to keep alive and keep yourself continually in the game. Now, this is the art of survival. And if you're a professional, it's the path to retention and successful financial outcomes. So if you're an investment pro, you become vital, not by adding 2 or 3% in alpha, but by reducing volatility and drawdown. So the key to minimizing drawdown is distinguishing between daily fluctuations, corrections, and bear markets. It is because bear markets, this is what blows up and destroys financial plans. So the key to surviving, thriving and success is avoiding these bear markets, especially when you need your money back, like if you're in the withdrawal frame. So the most effective and common tactic to avoid bear markets is simply to follow trends. Okay, so here we have the S&P 500. Notice if you go back to 1928, it doesn't matter which moving average you choose, they all produce better returns than the S&P with significantly less risk. Okay, so trend following works, but it's not without drawbacks. The first drawbacks is price trends generally are effective in avoiding these secular bear markets, but they are notorious for whipsaws, okay, by following the trend. And the next part is that following the trend almost guarantees you that you'll miss the initial run-up, which is often, almost always, the strongest point of investment returns. So how do we solve these problems? That is where volume analysis combined or using volume analysis with your risk management comes into play. Okay, so here's an example of, this is the PTCL. It's a ETF that invests in the S&P 500 and uses the 200-day moving average as its risk management or following the trend. Okay, and notice here that it has, because it has whipsaws and because it's missed the birth of the bull, it has drastically underperformed the S&P 500. So the more recent data here shows these flaws with just following the trend. Now we can repair this with the 4 R's of volume and incorporating volume into our broad market analysis. Okay, but there's a problem with market volume indexes, and that is that the data is flawed. Now, if you were to look up the volume on the S&P 500, how much of that volume do you think is attributed to the Mag 7 stocks? Now, those Magnificent 7 stocks, they represent approximately 25% of the price index. How much volume do you think those same Magnificent 7 stocks represent of the volume? Okay. Now, some people, you might think 30%, 35%, and actually you have to go lower. You have to go all the way down to 0. Okay. The Mag 7 stocks on most of your data feeds aren't represented in the S&P 500 volume. That's because the way that volume is reported is it uses tapes A, B, C. Tape A is the New York Stock Exchange. And because all the Magnificent 7 stocks trade on the NASDAQ, their volume isn't reported on tape A, which is generally the tape that's shown for the S&P 500. You think that's bad, it gets worse. even if you had the correct components in your volume data, they're way off because price indexes are formulated through capitalization, and volume totals are tallies. Now, I give you an example of this is Citigroup. Citigroup pre-credit crisis in 2007 was in the top 5% of the S&P 500 by weighting. And it had over 5% of the weighting of the S&P 500. Now, after the credit crisis, Citigroup falls, it becomes a penny stock. Okay, its attribution to the S&P went from over 5% to less than 0.1%. But how much of its volume contributed to the S&P 500's volume? Not 10%, but generally 20 or 30% of the daily volume was on one stock, Citigroup, that had virtually no impact on the price index. Okay, so here's the bottom line. Because volume is tallied and price indexes are weighted, small price stocks are overweighted, and the high price stocks are generally underweighted. And so the end results here depicted here in my slide. Therefore, if you're using traditional indexed volume data for your analysis, which most everyone is, like our lady here, you're on a date with the penny ones. So how do we fix that? That's what we're going to cover next. My volume factor intellectual property capital weights volume, harmonizing it with price. Because in volume analysis, the key is not volume, nor is it price, but understanding the relationship between volume and price. So here's the back test on my capital weighted volume, or this is actually dollar volume. So if you buy a stock today and that money comes out of the money market or your cash holding, that's new money coming into the market or capital inflows. If you sell a stock and you don't purchase a new one, that's capital outflows. What this index does, capital weighted dollar volume, tracks all the money moving in versus all the money moving out of an index to the penny. Okay, so you can see here that in the dollar volume that we've significantly outperformed the market over the last 2 decades while taking on significantly less risk. Okay, the red arrows are sells, the green arrows are buys. Okay, when the chart's green, we're in. When the chart's red, we're out. Okay, the same thing here is with capital weighted volume. This is the same thing, except we don't use price in the calculation. Again, significantly outperforming the market. This time with even less risk than the dollar volume. Okay, some of these signals are aligned, others do not. Okay, so moving to, you not only have to have, if you're going to play sports, you not only have to play offense, you should also play defense, even though very few portfolio managers play defense, and they mostly just play offense. But the other portfolio managers that play defense, hardly anyone plays special teams. So to give you an example of special teams and why they're important, you might think back to that Michigan-Alabama college playoff games where special teams nearly cost Michigan the game. What is special teams? Special teams is transition from defense back to offense. This is important because generally the most significant and powerful segment of a bull market is its birth. Yet trend systems, almost by definition, can't catch the bottom. They only re-enter after that explosive move to the upside. So to explain how this works, think about this. Do you know anyone who's always right? Okay, you probably don't. But you probably know several people who have a knack of always doing the wrong thing at precisely the wrong time. So there's a symbol to track these people who buy on greed or the fear of missing out, and then sell on fear or panic. Okay, that symbol is here listed here. That's the spider, SPY. Okay, the spider tracks the S&P 500 index to the T on price. But we're interested in here is S&P-wise volume and looking at the sentiment of these specific traders. Okay, so what we're looking for is to identify capitulation re-entries, is for the SPY volume to blow up. So to go up 25%, 50%, 100%, 200% or more. Okay, that's what we're looking for. And that's going to cause our VPCI index to fall. And when it falls to a -4 or below and falls below its standard deviation line, that is the setup that tells that the market is near a wash up. The trigger is then when it crosses back above the lower Bollinger Band. Okay, that tells us that the market is capitulation. Okay, this is my favorite one, March 2009, the very low. We got the signal, the closing the day before, and this is, I still hold some of these trades in my accounts. I just hold them there as trophies because it has my date of purchase and my cost basis. Okay, so give you another example. This is the one that's often asking me, what about the pandemic volume? Okay, pandemic bottom. Okay, so this is the same thing here. We got in here a few days early. I think we were in 3 days early here on 3/19. The low was on 3/21. Okay, now the W bottom is the same thing as the V bottom, except it's a shallower bottom. It doesn't have to reach that -4. It just has to be negative, but it has to happen 2 times in a row. Okay, by the way, this signal here on the V bottom was called in my volume analysis commentary, as was this W bottom, which happened here on October 1st, 2022. So again, this was called out in my volume analysis flash updates, and you can go to my website buffdormeier.com and you can sign up for those. They're the right price. They're free. So a W bottom is 2 V's in a row, 2 shallow V's in a row. Okay, when we add, this is using 50% capital weighted volume, 50% capital weighted dollar volume, and just the VPCI V bottom. You can see that we significantly improve our returns by adding these V bottoms in while keeping our risk very low. This brings it up from just the past 2 decades, from 2000 to the end of last year. Again, doing very well, very high risk-adjusted returns, and nicely beating the market on an overall basis with less risk. So we're going to finish out here by talking about where the rubber meets the road. So many people, the primary objective is returns, but job number 1 is capital preservation, because preserving capital will lead you to that successful financial outcome. So here we are going to use that $1 million illustration again. Someone retires with $1 million, and this time they're going to take a 1% quarterly distribution using the endowment method of withdrawal. What the endowment method of withdrawal does is it adjusts the withdrawal in consideration of the portfolio's value. Thus, if the portfolio appreciates, you'll take more money out. But when the portfolio depreciates, you take less money out. Okay, this will significantly help our results. Okay. So in this illustration, we're going to put we're going to invest $1,000 again into the S&P 500. Okay, we're just going to do that passively. And then the second one, we're gonna use we're gonna use the S&P, no volume factor offense, but we will use capital weighted dollar volume as the risk overlay with the V bottoms included. So we'll have a portion of our defense and a portion of our special teams, okay, to kind of keep it more vanilla. And so in this illustration, over the 20 years, the $1 million grew to 1.4. Okay, but using the risk overlay and special teams, the defense and special teams, it grew to 2.7. Okay, now what may be more important to you is how much income that you actually took out. In the last quarterly draw, with using the passive strategy, 14,445 versus the risk overlay, the volume factor risk overlay, 27,718. Okay, that's a pretty significant difference in lifestyle. And over that long period of time, over those 20 years, this millionaire took out 673 in withdrawals versus using the risk overlay, they took out 1.1%. That's a significant improvement. Okay, that is a that's a lifestyle. On this example, $34,000 a year, not that much for someone with $1 million, versus over $55,000 a year lifestyle using the risk overlay. That's a 40% increase in cash flow. So if you were to add all these numbers up, the passive strategy with the amount of money they have and what they took out is 2.1 versus the risk overlay, the volume factor risk overlay, 2.7 plus 1.3. They took out almost 4 million or 3.9. So here's the point. Investing returns should not be as important as your outcome. And to illustrate this one more time, we're going to turn back the page, okay? So what I just showed you was the end of the story, okay? But if you open the book up, there are chapters in our story, okay, that look a whole lot different than the ending. So in 2002, the end of 2002, using the S&P endowment method of withdrawal, 1% a quarter, the money shrank to 553. Versus using the risk overlay, the money's still growing. The distribution shrank to this versus a growing income of here with the risk out using the risk volume factor risk overlay. 2008, over half their money's gone, where here our capital is still growing, and and the distribution is cut in half versus a growing distribution of 11,300. Okay, so from a real life perspective, the life dreams of this passive investor were sacrificed on the altar of volatility. Whereas the person using the volume factor tactical risk overlay, they were able to enjoy the retirement they imagined while foregoing the emotional distress of volatile markets. So this comes to this last point again. Investment outcomes are what matter over investment returns. This is your art of survival. Risk management is your differentiator. So hopefully by now I've provided you with compelling evidence that volume is not only a factor, but the factor that rules them all. But if not, let me leave you with this one last nugget, okay? The FAMA French model is the gold standard of factor investing. It is thought that a factor must have a p-value of 0.05 or lower to be a factor. Now, most recognized investment factors struggle to meet this criteria. The best, which are typically momentum and quality, generally have p-values of 0.01. So Dr. Matthew Luty ran the Fama French market, and he used my capital weighted volume as the defense. And then he used my VPCI as the offense and special teams. And he published the results in the article in the Journal of Accounting, Business and Economics, JABE, the JABE Journal. Okay. Now, the volume factor was not 0.05. It wasn't the 0.01 of the best factors. It wasn't even 0.001. It was 0.001. That means it's literally off the charts, a class of its very own, 100 times greater than the best factor. So here's how you do it. Okay, if you're interested in this, July 2nd, my new book comes out. Okay, the volume factor. Okay, this is where you can learn about the volume factor strategies and the techniques. Now, I can't talk about investment products in this venue, but as John mentioned, my title is Monarch Funds ETFs Index Specialist. So remember that volume factor. Got a few more minutes here, so let's just give a quick update on where we are with this market. This is capital weighted volume, okay? Well, you can see that volume, capital weighted volume, has led the market higher since 2023. Okay, it's leading price, and it's hit new highs, consistently hit new highs well before price has. This means volume is leading price. The same with capital flows. Capital flows are also leading price, hitting new highs consistently, leading price much faster than the price indexes. So this tells us that that the market currently is in a very healthy state and strongly empowered by volume. So remember, one thing, if you take one thing out of this thing, remember, volume is the force, and you want to be on that same side of force. So if you're like Yoda, what did he say before engaging in an important mission? May the force be with you. You want to make sure that when you're looking up your chart, that you are also looking at that force. So the force may be with you. Volume is the force of the exchange market. So that's I apologize for the interruption there. I see that I have a few questions. Okay, more of a statement here. Yeah, nobody knows what's going to happen in the future. And past results don't indicate future success. But I think what you can take out of this is that volume is a valuable piece in looking at the picture and helping solve the puzzle. Okay. Yes, there is a fund that uses this. I can't talk about it here. There's actually, I launched 2 ETFs just a few months ago. They're based on SMAs that have a track record. I can't talk about that either, but it's I better not go there. But I think you'd be very pleased with it, extremely pleased. So yes, there is a way to access this in a very tax efficient way. John, you have any final thoughts for me? I apologize. I'm taking it right down to the wire.
No problem. Everything you have to say is fascinating. So I'm sure the listeners appreciate everything you have to tell us. just to remind everyone to take advantage of Buff's offer, click on the link in the chat box on the right, buffdormeier.com. That'll take you to the dedicated sales page with his one-time only offer today. So Buff, thanks a lot. Great having you here. And we look forward to having you back sometime in the future.
All right, very good. My website is just my name, buffdormeier.com. Then you can learn more about the volume factor.